Okay, good afternoon, ladies and gentlemen. Very warm welcome to the weekly market review for the 2nd of May. For those of you who didn't have to work yesterday because of the public holiday Labor Day, so happy Labor Day. Hopefully you didn't do any kind of labor yesterday. I, for one, was cleaning my son's fish tank, which took quite a few hours because of all the, fish tank, always very messy kind of stuff. Sunny was probably washing his 3 Ferraris and 2 Lamborghinis. I'm not quite sure. I think you should get a Subway brief for the
Yeah, the washing was quite easy because they are toy miniatures, so don't do a few minutes.
That's a good one. So Matchbox.
Yes.
All right. Oh my goodness. All right, so we're off to a shortened work week this week. A couple of key points we're gonna highlight and let's get going. So obviously the disclaimer is that SIAS is a charity. We're not registered by MAS, so whatever that we talk about today cannot be misconstrued as a recommendation. So do speak to a licensed financial professional before taking any kind of action in the capital markets. All right. So before we get to the content, just want to keep everybody informed that the next SIAS session for the month of May is going to be on the 17th of May. This is a Wednesday, 7 p.m. So if you want to choke your seat, this is the QR code. Best to do that because there is a fixed number of slots even for Zoom. And obviously, we cannot fit 6 million people entire population of Singapore. So do choke your seat. Then this is, of course, the QR code if you want to sign up as a member. So FYI, the membership for SIAS is $1 per month, which works out to be $12 per year, which is less than what you'll pay for a standard mala meal delivered by Deliveroo, because I know I pay $21. Yeah, so this is cheaper than that. Okay, into the material now. Let's talk about the U.S. economy. The U.S. GDP is slowing. So the first quarter GDP growth on an annualized basis clocked in at 1.1%. The consensus estimate, I beg your pardon, was for 1.9%. So you can see it's a huge delta, difference of 0.8%. Now, if you look at the top panel here, as you can see, the quarter-on-quarter change is obviously coming down. And we are still, or rather the base scenario is that we are still on track for a technical recession in third and fourth quarter. That means back-to-back 2 quarters of negative growth, hence technical recession. On a consensus basis, if I look at the Bloomberg terminal, the probability of a recession in the US is now at 65%. Of course, if you talk to I think it was JP Morgan, yeah. If you talk to JP Morgan, they would say that the recession is inevitable by the end of the year. If you look at Bloomberg Research itself, it's 100% probability again by the end of the year, but could start as soon as June, which is next month. All right. And again, I've been reading some reports. There are some other market participants that also have got a more gradually becoming more pessimistic view. A lot more voices. There's nothing to say that the recession is going to start in June. Okay. Now back to the first quarter GDP numbers. The slower growth was mainly driven by inventory drawdown. So what that means is that the corporates are not building up the inventory. They're actually letting it draw down. So let's take a second to think about this. Why will a company not backfill its inventory? Well, you will probably only do that if people, your products are flying off the shelf, people are buying like crazy, so you got not enough time to kind of rebuild inventory. Or two is that companies are deliberately not building so much because they think they can't sell so much in the future. So I would probably go for B, right? So because the companies are also thinking that there's probably going to be a recession. And there'll be less spending. But that is in the future. Now, if you look at the April numbers, or rather the first quarter GDP numbers, let's unpack it. So you've got inventory drawdown, but that is slightly offset by higher consumer spending. But again, do remember that this is for the first quarter. The second quarter, we expect a much dimmer or slowing consumer spending. And of course, when we head into the second half, then of course you'll go down even further. All right. Now, so that is the GDP in the US. Now, if you look at the inflation numbers, you always have got the headline, then you got the core inflation, then the super core, so on and so forth. There is this other inflation index called the PCE, the Personal Consumption Expenditure. So, allegedly, or what is commonly assumed, is that the PCE is the Fed's preferred inflation index. So, in a general case, PCE it excludes food and energy, but I think they do, I guess, compile index slightly different weights. So it is not the same as core inflation, I think. But if you look at the PCE, the latest reading for the first quarter of 2023 stands at 4.2. As you can see, the number has been coming down since the first quarter of 2022, but the first quarter of 2023 actually went up. So the trend has changed. Not sure whether this is going to be a continuing trend, but not good because one data point is moving against the grain. If you look at the year-to-date number, it's 4.9% year-to-date. Can think of this as similar to a moving average. So it is moving up. So the picture here is that the headline numbers could be coming down because energy prices are far less than they were at the peak in 2022. But if you look at the PCE, which is similar to core inflation, it is extremely stubborn. In this particular reading, it's actually going up, wrong direction. Now, let's combine it with the latest reading of the U.S. consumer confidence. Now, there are two consumer sentiment indices. One is by the University of Michigan. The one that I'm going to be talking about right now is the one by Conference Board. So the reading came in at 101.3. All right, now the number itself, not going to talk about that, but if you look at the trend, the chart here, you can see that it is obviously coming off, right? So the peak was reached somewhere in the middle of 2021, simply because that was a time when we were heading out of the COVID lockdown, so and so forth. But the latest reading actually is a continuation of the downtrend. So consumer confidence is falling. Now, what is also notable is that the actual reading of 101.3 is below the consensus estimate of 104. So again, it is not as good as expected. Moving on, if we were to, or rather the Conference Board, as part of its data collection for its consumer sentiment survey, right, also asked questions to respondents. So the questions they asked, or rather one of the questions they asked would be whether or not consumers think jobs are plentiful. Now, this is the reading for April, right? So consumers say that jobs were plentiful in April. But at the same time, consumers also said that in the next 6 months, jobs will not be plentiful. And this is basically a reflection of growing pessimism in the overall business conditions, as well as labor markets. So if you look at the white color line, the reading is 48.4. So that's consistent with the sentiment that jobs are plentiful. Now, if you look at the blue color line, it's again very clearly this is a downtrend. The reading is 12.5. Oh, this is so low. Again, this is reflective of the overall comments that consumers, that means ordinary people, they think that jobs will not be plentiful 6 months from today. Again, another piece of information that reinforces the narrative that the second half is going to be challenging. Now, so the situation is this, right? We have got slowing U.S. GDP growth. But the overall full year GDP growth for the U.S. is still going to be positive. And the second quarter GDP growth is probably going to come in just a little bit above zero at 0.2%, which again suggests that, or rather is a good setup for the second half, which is expected to be underwater, negative GDP growth. Now, so that means GDP growth is coming off, yeah? Now, we also have got another piece of information. So the initial jobless claims for the week ending the 22nd of April came in at 230K. That means the number of people claiming jobless claims because they were made redundant or fired. So that's 230K. Now the versus the previous week's reading of 245K, and the consensus estimate was 248K. So as you can see, the actual number is below the consensus as well as previous week. So which means that there are less people applying for jobless claims. That means there are less job losses. So the picture is this, right? GDP growth is coming down, but the labor market appears to be still resilient, right? There are less people losing jobs. So what that suggests, right? And again, you combine it with the PCE numbers, right? The personal consumption expenditure numbers. The narrative is that there is persistent wage inflation. All right. So the labor market is still relatively resilient in the US. Wages are still relatively high. So that's why it's driving inflation. Okay. So we got slowing GDP growth, rather high inflation, combined with the last few weeks drama of the financial stresses and several bank failures in the US, which culminated in this weekend's takeover of First Republic by JP Morgan. It is increasingly becoming hard for small businesses to get loans. There was a report that I read just now that suggested that it is so hard to for small businesses to get loans that the number of what you call the distressed loans has increased by 300%. That means, distressed loans are basically not investment grade, almost default, has increased by 300%. Wow. So as you can see, this is kind of coming to a head here. So the base case scenario is that we are probably going to be seeing a technical recession, so negative growth in third quarter and fourth quarter. But the headline inflation is probably going to be still above the Fed's target rate of 2%. So we have got a technical recession plus elevated inflation. This is the classic definition of stagflation, something that we have not seen in a couple of decades, I think. So it's going to be an eye-opener for most of us. The good news is, of course, this is expected to last only for 6 months. But it's going to be a rough 6 months, I believe. All right. So with that, I'm going to end my presentation and hand it over to Sunny. Sunny, as usual, is the good cop. I'm the bad cop. I give all the crappy news. Sunny will tell you how to buy a Lamborghini.
Not really. The economic situation doesn't really look like it's time to go and buy a Lamborghini yet. But first, as usual, come back to that point of buying a Lamborghini. This is in regards to the market cycle, which we will see a very uncanny resemblance with the S&P 500. I'll go to that shortly. So let us look at the CME Fed Watch tool first, which calculate the probability of a rate hike using the Fed Funds futures pricing. So 1 week ago, the probability is at 90.5%. Yesterday, when the First Republic Bank was seized by the regulators, and then after that sold to JP Morgan, the probability went down to 83%, but today we are seeing it back up to 93%. So this 25 basis point hike, bringing the Fed fund rates to 5 to 5.25% is most likely baked into the market right now. So we are expecting on Wednesday night, another 25 basis point hike, which will be announced on Thursday morning. On the economic front this week, of course, we were expecting, like I said, Thursday, the Fed rate decision of another 25 basis point hike to bring it to 5.25%. And then the following day, Friday, we would get the blockbuster number from the non-farm payroll numbers, which is expected to come in at market consensus of 180K versus the previous reading of 236,000. Unemployment rate is just going to tick up 0.1% as expected by market consensus to 3.6% from the previous 3.5% that we saw. On the earnings side this week, I think a lot of people will be very interested in Apple earnings. Apple earnings coming out on Thursday as well. So the consensus is earnings per share is coming in at 1.43 versus the previous earnings per share of 1.52. Revenue forecasted at 92 billion versus the previous 97 billion. So this is a move downwards for both the revenue as well as the EPS side. So coming to this psychology of a market cycle. So we can see hope, euphoria, complacency, anxiety. These are the major stages. Now, if I'm looking at the charts right now and I zoom out all the way to look at the long-term side of it, which go all the way, as you can see, 2019, 2020, these are the dates below. You can see that we have this very strong uptrend, which is the COVID recovery. So this is what happened. This is the hope, optimism, thrill, belief, and euphoria. Then with the market tanked a little bit, which we went to the October bottom, and then of course starts to rally back, and then we got some complacency here. So this uncanny resemblance, all this euphoria coming up to the peak here, and then we have this coming down, and then we have now this zigzag range-bound kind of trading. Seems to me that we are inside this complacent zone. So I'm a bit cautious lah. So not time to buy the Ferrari yet. Okay, so let's zoom in into the technicals of the charts right now. Okay, so compared to the S&P 500, which is the broad market index, including the small and medium enterprises in US, the Dow Jones Index contains the top 30 companies in US according to market cap, so they are much, much stronger. So I'll just zoom out a little bit also. As you can see, you should be familiar with this downtrend rate line that I have for quite a long time right now. This is connecting the peak in the early part of 2022 as well as the peak in December last year, thereby forming this downtrend line, which has been intact for the first quarter of this year. But yesterday or last week, I would say, Friday or Thursday, we can see that we have two very big green candles, which is a convincing break above this downtrend resistance line. So that I would say have already breached, and that would make this this resistance downtrend line invalidated right now. So I'll just delete this downtrend line away. Okay. So but then we are still facing this double top formation, which is the high between the January and February period, which we have covered quite a bit in the last two weekly market review. So as you can see, as we approach this level, which is the 34,281 level, this will be a major resistance for it to be tested and break through. So we are actually leaning on the earnings of this earnings season, which about half of them have reported so far, and a lot more going to report this week. So far, the numbers that come in are still within expectation. Hence, there is not much of a surprise. So I believe also this double top formation, which is a bearish formation, is still likely to hold for the Dow Jones Index. So we are likely to see this is where the peak the Dow Jones Index will be heading for the near term. If you look at the indicators, the MACD indicator is negative 4.87, now crisscrossing between the MACD line and the signal line. And the histogram is also starting to trend down below the zero baseline of the MACD histogram. So a bit of an unclear signal, but of course, towards the downside would be what's the indication going to be, given that we have a negative histogram reading of 4.87. Next, we look at the RSI level. The latest reading we have at 60.30, which is a healthy reading above the 50-point neutral mark, thereby telling us that we have healthy uptrend momentum in Dow Jones Index right now. And I also like to take note that this is also very near the 14 days RSI-based moving average, so which is quite in line with the past 14 days kind of reading. So we are not into the overbought area of about 70 points and above, but then we are also not that bad that we are below 50 points. So there may be still some healthy momentum inside the Dow Jones Index points. However, with the contradicting signal between MACD and RSI, I felt that, in my opinion, the double top formation is likely to hold for now until the end of the earnings seasons. So let's move to the scary S&P 500. Okay, after we zoom out, now let's zoom into what happened recently. So the recent peak that we saw in the S&P 500 is this red line over here, which is the year-to-date high in February. That's at the level of 4,195 points, or the 4,200 level, the handle that a lot of analysts are watching also. So same thing. We have a Thursday, Friday that was a very good in the performance because of earnings season's results led by the tech sector, especially Meta, Facebook shares, which rose about 14% on that day of the announcement. But on yesterday, Monday, the index starts to come back down again. So S&P 500, I would say, as I said earlier, containing the mid and small enterprises in US would be more subjected to the downturn if the Fed increase interest rate further, and then more regional banks will be in danger of collapsing, like what happened to First Republic, as well as some of the smaller enterprises. So there may be a bigger retracement to the S&P 500 should a bad economic, macroeconomic situation happen as compared to the Dow Jones Index. So not optimistic, but then the resistance towards 4,200. And then we have this level over here, which is a double top formation between the November and the December period last year. Double top is a bearish formation, but that could, however, becomes a, if it has a change in polarity, it might provide a support for S&P 500. But looking at the indicators right now, with the MACD also reading negative, it looks like this double top level is not going to be relevant right now. As you can see previously in the past week, we have also tested this and managed to break through without much of a resistance. So this is not the level to watch. The level to watch for a support for the S&P 500 will be the year-to-date low at the 3,810 points, which happened during the March of this year. So at this level, you can see during the December period, as well as early part of this year, there's a lot of consolidation, a lot of buyers coming in to push up the market. So this is the right support level to watch, 3,810 points. MACD indicator, negative 1.32. So it's just below the zero baseline for the histogram, and the MACD line is also below the signal line, although it's trying to cut back above, but I think that will be short-lived. RSI reading at 60.84, healthy kind of reading, healthy kind of momentum in the index right now, slightly above the moving average, 14 days moving average of the previous 14 days RSI reading at 59.30. So there may still be some support for the S&P 500. However, the resistance is likely to hold. So a kind of a range-bound kind of trading unless we have a earnings surprise coming out for the second half of the earnings season. So this is what is expected of the S&P 500. Next, let's move to the tech-heavy Nasdaq Composite Index. Nasdaq Composite Index closed yesterday at 12,212 points, very close to the 12,269 point year-to-date high, which happened in January. So all three indices are sort of testing the year-to-date high right now, and whether we will break that or not, that's a question mark. But in my opinion, it will be unlikely to break through this earnings season, as we are also heading into a recession starting from June, which is what a lot of analysts are expecting. So support level for the Nasdaq Composite Index. So this area over here, same thing. December double top formation last year might have a change in polarity and provide a support for the Nasdaq Composite Index. If we go below that, that would be the year-to-date low of this, not the year-to-date low, but actually the low that we saw in March, which is the 11,035 points level for the Nasdaq Composite Index. So this is the range that we are looking at for the Nasdaq Composite Index should a retracement happen. Now, whether a retracement happen or not, we have already come close to testing the year-to-date high one time over here in the end of March, another time over here in the middle of April. So now we are in early period of May already. We are testing it again. So this formation, I would see it as a mini triple top formation as well, which is a very bearish signal as well. So I expect some retracement at least to the double top formation here, 11,571 points for the Nasdaq Composite Index based on the critical level itself. Looking at the indicators, the histogram is negative 6.43. So that means there is negative momentum in the Nasdaq Composite Index right now. The RSI is contradicting the MACD reading right now, with the reading at 58.78, 3 points above the RSI moving average of 55 points. So there may still be some uptrend momentum in the index point of the Nasdaq Composite Index. Now, do take note that RSI is a past 14 days reading, so it may be a bit lagging, while MACD also a past reading, but the crisscrossing of the signal line and the MACD line might provide indication of where the direction might be heading into the future. So contradicting signal means it's not a convincing, like a buy kind of a conviction. So it is likely that we will be range bound and still be capped at the year-to-date high that we saw this year for the three major U.S. index. Next, let's move to the Asia side. We have seen that Hang Seng Index is trading already today. And you can see that it is still in a kind of a range-bound mode. In fact, a lot of the markets, including the U.S. and the major indices, are in range-bound mode because a lot of us are waiting for the FOMC decision, which is coming in on Wednesday night, Thursday morning, before we predict or sort of make our next move in the markets. So I think it is still the low of the year-to-date low of the Hang Seng Index this year is still intact at the level of around 18,829 points. That is the level that I'm looking to get back in on the Hang Seng Index. However, it's not there yet, so I'm still being very patient. And with the rate hike announcement coming in this week, I believe that will be detrimental to most of the major indices. Hence, it will likely come down to the level that we want to get in at a safer risk to reward ratio at the support of the year-to-date low for most of the Asian index. So MACD reading for the Hang Seng Index negative 54.33, so negative momentum right now. And RSI is at 46.83, below the 50-point neutral mark, as well as below the 14 days RSI-based moving average at 49. So sort of weak momentum and negative momentum, negative direction. So Hang Seng Index should be coming down towards the year-to-date low, which will be provide an opportunity later on should it come and test year-to-date low later. On the STI Index, which was up about 1% this morning, a very strong kind of performance. This is on the back of the DBS announcement, which announced a record quarter again, record revenue again for the bank. So on top of last Thursday UOB announcement, also a very good performance. These are the major components of the STI Index, thereby keeping the STI afloat. Now you notice that today's trading, the candlestick or the candle wick on top of today's candle is quite long. This was the announcement that happened this morning, and then that brought the index up 1%, but then you can see that investors or traders are scaling back that rise now. Now the 3,300 point resistance level is still very much intact. 3,300 handle is still the resistance level to watch for the STI index, because that was the peak that we saw this year around the April period, which provide a resistance level, of course, of the long candle week. And also you can see that towards the end of April, when it starts to test the 3,003 again, market is not confident enough to break through, and hence we can see that the pullback happened. So it is still, we are still going to watch the 3,300 handle as a resistance level. Now for support level, it will come in very near over here, the December low at 3,225. That will be the first level of support. If we break that, we have a uptrend line connecting the low of October as well as March this year, which will provide further support to the STI index. Now the MACD index is a very clear signal here. MACD line, the blue line below the signal line, thereby it's a negative momentum, negative trend for the STI going forward. Histogram reading at negative 4.94 is below the zero baseline already. So negative momentum plus a pullback slightly to be expected according to the MACD indicator. RSI reading at 52.57, although it's above the 50-point mark, it still have uptrend momentum, but this uptrend momentum might be a bit weak compared to the 14 days RSI moving average at 56.80. So MACD negative, RSI is weak. I think 3,300 resistance level will still hold. Hence, I think we need a pullback of the STI to at least the 3,225 points level before we can stage a rally again to break above the 3,300 handle for the STI index. So that's my take on the major indices this week. And anything else to add, Benjamin?
Well, you know, the big tech stocks in the US seem to be surging. So you've got really good numbers, well, better numbers, you know, Microsoft, Amazon, so on and so forth. Meta as well. Right?
Yes.
So it looks as though the restructuring that they've gone through, firing legions of geeks and holders have kind of paid off.
Yes.
Right. Do you think that's temporary? I mean, that's, you know,
I would think this is a reset time for the tech industry. We have been hiring for the past 2 years, at least, especially during the pandemic with the digital boom. So it's a reset now. And will it be detrimental to the sort of the bigger picture? I think no, because this tech savvy professionals will be heading to the other industry to spruce up our digital banking and stuff like that. So I don't think it will be a dampener. But then what is very clear is, with the retrenchment happening around the top tech companies, it will improve their profit margin, it will improve their baseline. This is definitely good for the tech sector, and hence, going forward, I believe the tech sector will still be leading the rally, if a rally is going to happen real soon.
Okay, good. So we'll watch out for that. All right. So thank you very much, ladies and gentlemen, for joining us today in our weekly market review. Hopefully the comments that we've put in will be helpful for you in this week's trading. So as usual, have a great week ahead.